Okay, this is part two of my video for Sunday the 14th of October 2018. Just talking about how the S&P is unlikely, or the US stock markets are unlikely to crash after last week's significant decline. It doesn't usually happen. Crashes don't just come out of the blue one day and happen. It did happen in 1987. I'll show you that in a minute. I was actually trading back in 1987. That's when I started my career. So I've been doing this over 30 years. I've seen every crash since 1987. I've actually traded every crash since 1987. So I think I've traded every significant event. So I have experience of crashes. This is how I've spotted crashes in the past. Very simple, not rocket science. It certainly wasn't the only one to spot them. They're just very basic patterns. Now, there's a clear head and shoulders in 2011. This wasn't a significant crash, but it was a good 25% off, something like that. We tumbled from 1355 to 1077, so nearly 300 points, 275 points. And that was triggered by this head and shoulders pattern. So very simple. Broke the neckline, bang, down we went. At the base of the once the global financial crisis played out through 2008, 2009 March was the absolute low at 666 for the E-mini S&P. You can see we did also have an inverse head and shoulders pattern here, which would have given you a clue as to why we were as to how the recovery might work. And you can see we even came back and tested the neckline and then rocketed higher. That neckline with 100-week moving average would have been a really nice buying opportunity if you'd missed this move. So that was interesting. I bet you if I throw some fibs on there, actually, they will coincide nicely. There you go. Look, this often happens. So the 38.2% fib at 1006 coincides nicely with the 100-week moving average and the neckline to the head and shoulders. That was just good. Would have been the perfect buying opportunity, and I'm pretty sure I would have spotted that back then and told my subscribers to get long. And then, of course, the bull market just took off. Now then. I'll take these off so I don't get confused. Right. Now, if we go back to the global financial crisis, the peak of the 2007-2008 market, I'm pretty sure that this showed something significant as well. Can you call that head and shoulders pattern? Hold on one second. There's the head and shoulders pattern. So the left shoulder, the head, the right shoulder, there's the neckline. Once the neckline broke, we came back to retest it, which we often do, and there was your selling opportunity. And note how the 100-week moving average was again a factor in all of this. Once we started to settle below the 100-week moving average, which I'm guessing we hadn't done for quite a significant period of time, look how the 100-week moving average was just great support in the bull market leading up to it. Yeah, we hadn't been below the 100-day moving average since 2003. So that was 5 years of the 100-week moving average acting as excellent support, and then became excellent resistance. Once we'd broken the neckline to the head and shoulders, we came back again. We didn't quite retest the neckline. We missed it just by a bit, held more by the 100-week moving average, and then this is when the crash really started. So although we peaked in 2007, you wouldn't really say that the crash started until May 2008. That's when we absolutely collapsed, and we spent nearly a year crashing. So all those moves, all those peaks and crashes were easily spottable, and I did actually spot them, and I did actually tell my clients that that was going to happen, so I was quite pleased with myself with that. In the year 2000, I didn't spot this. There wasn't anything clear, no particular pattern, but you can see that the market had become very volatile in the year 2000. Leading up to it, we had the usual bull run with everything fairly calm, but big volatility started in 2000, and that did indicate the bulls and bears were battling it out. Admittedly, we are getting a similar scenario in 2018. We'll go back and have a look at that in a minute. And then once this trend line broke, down we went. But I can't say that there's a particularly clear topping pattern, only that the extreme volatility did give us a warning that bulls and bears were having a battle. This chart unfortunately doesn't even go back to 1987, so I can't show you what happened when I started my trading career. But if we go back here, yeah, there is. It's not a dissimilar pattern. It's not a dissimilar price action to what happened in 2000 with some volatility. But I think we need a lot more volatility before we can start to call this a market top. This is a very quiet period where we ran up here. You know, we only had 2 months of volatility here. I think we're going to need at least a few months of volatility here to indicate that bears really are exiting this market, or that the longer term longs, the clever money is exiting this market, and that we're going to collapse. So I'd give it a little bit longer before we see the crash. Talking of crashes, Bitcoin. Well, very happy to have picked the peak in Bitcoin when we got up near 20,000, and then since then I've been calling it lower for the whole year. We've caught pretty much every bounce, almost to the pip, and I've been negative the whole year. I had one or two bullish calls where I thought we might just break higher, but they quickly told me that was not going to happen, and we got short again. So as you know, I had 6,600, 6,650 as the big resistance and selling opportunity, and that's worked really well this week as we've collapsed 600 pips or so from our selling opportunity. Nice opportunity to bag some profit there if you were trading this. I hope you were. Very clear, 55-day moving average, and this trend line just holding nicely. So what we need to now do is break 6,000. This is this little trend line down here that goes back to the beginning of June, 3.5 months old. Once we do that, we'll be testing the crash low of 57.80. I don't see any reason why that's going to hold, and we should continue lower. I don't see anything bullish in this chart. We'll have to get back at least above 67.50, 6,800 before I can even think about getting bullish about this chart. And even then, yes, we can have a good run up to the 7,200 level, 7,300 level, which is probably the peak in September as well, 7,400. Okay, so 7,200, 7,400 will be the next target and resistance, and it's only really above there that I can start to talk about a bull market forming. So for now, yeah, it looks pretty negative for Bitcoin. E-mini Dow Jones, it's actually probably a little bit clearer than the S&P chart. You can see that we held this trend line going back to May, 1, 2, 3, 4, 5.5 months, and we closed above the 200-day moving average, struggling at the 100-day moving average, but I don't see this again as the beginning of a crash just yet. We're getting into oversold territory. We'll see what happens, but we've got an inside day on Friday, so that's a little bit more encouraging for the bulls. I think we can recover. It'll be interesting to see what happens. Maybe we'll rally all the way back up here. Maybe we'll get a double top, and then the crash will come, and there'll be some significant money to be made when it does happen. And it has to happen eventually. People have been calling it for a long time. I haven't. I've just stuck with the trend. Actually, we do have something of a double top here. 26,684, 26,99, 26,966. I think that can count as a double top. It doesn't have to be exact, especially when you're talking about such a big market. That can count for me as a double top. So, well, let's see what happens on this bounce. Let's see if we do rally out and get a smaller double top and then collapse. Interesting, but I don't think we're ready to collapse yet. If we broke below 24,000, that would be significant, as you can see. I'm going to wait and see if we get a topping pattern. In my gut, I think we're going to bounce this week. I think we're going to have some sort of recovery, and that recovery should give us an idea as to what happens next. This is the 4-hour chart, so you can see the short-term fib levels kind of working. 38.2 on the slightly shorter one, shorter term chart works around the 25,200 level. This confluence of fib levels around the 25,380, 400 level seems to also be having an effect. The 500 period moving average is doing its job, and so is the 23.6% fib at 25,685. So stick these fib levels on your chart and see if they still work for you. This would be a good test. If we manage to get up to 26,150, 26,200 and stop there, well, it would certainly be worth trying shorts with a stop above this 200 period moving average on the 4-hour chart. Maybe that will be the trigger for the next leg lower. Interesting stuff. We'll just see how it develops. Now this is the way a crash begins. This is the DAX. Now, I've been talking about, if you've been following my DAX report, I've been talking about this head and shoulders for a long time. I'm sure I'm not the only one. It's very obvious. I'm sure other people have spotted it. It must be all over Twitter. Left shoulder, head with a double top, right shoulder, and then down we go. So we're testing the neckline. I don't think we're going to break the neckline. Well, we certainly didn't break it on last week. The neckline's around 11,500. The 200 week moving average is a little bit lower at around 11,450, and that worked. Okay, we did overrun as far as 11,383, which must have made the bulls worry, but we closed just above the trend line and the 200 week moving average, so we could get a little bounce back. There's going to be some shorts out there now getting excited, thinking this is going to break, we're going to crash, and I don't think it's going to happen. I think we'll bounce back first. We might even get up around the 12,000, 12,100 level. You can see there's a trend line there. going back to, yeah, that must be this one. Hang on, just let me check. Get this right. Yeah. So that's my little trend line going back to this trough down here, this low for 2016. If we were to bounce back to that, that would be a good selling opportunity. And we'll look at selling opportunities if we do get the bounce back that I think we're going to get. Now, if we don't, this is the classic top, period of volatility. We're already below the 100-week moving average, so that is negative. Once we broke below there, you can see how beautifully the 100-week moving average held the first dump at the beginning of 2018. Bounced back, held the second dump into June, July, and then we just couldn't hold it any longer. And by September, we broke below it. So this was important, and we just couldn't get back above it on the retest. That is what sent us significantly lower. 3 weeks we tried to get back above the 100-week moving average, and we just couldn't. I did have selling opportunities up there. It was really nice. In fact, I had it at this fib level, I think, if I remember correctly, 12.420, 12.440 was our big level, and that was a real nice trade if you were following the DAX report. Anyway, we collapsed, not surprisingly, and we broke below that trend line going back 2 years and 10 months. This will hold, I think, as I say. Let's see where we get. Let's see where we bounce to. But this doesn't look good in the longer term, and this is probably indicating that world stock markets will crash eventually.